Hello class, Tom Simmons here, reporting from my back porch in Shelburne Falls, Massachusetts, where I'm home now after having just done my bi-weekly shopping trip. Every 2 weeks I do the shopping for the household, and I don't even bring a list with me anymore because there are certain items that we simply consume and we simply purchase every single payday. And I know I'm going to be getting 18 eggs and several gallons of milk and cheese and fresh Atlantic cod and boneless, skinless chicken breasts and a certain amount of pasta, coffee, gotta have coffee, and there's certain things on that list that we get all the time. And it's so precise and so much the same from shopping trip to shopping trip that I pretty much know within about $10 what my total bill is going to be when I get to the cash register. What I've really done, and I check each week to look at those receipts and look at those prices and make sure that everything was rung up correctly, and to check how prices have increased or decreased since my last shopping trip. What I, in essence, have done is exactly the same thing the United States government does when it measures inflation or deflation in the society, the level of prices of a market basket of goods. And that's what this particular video is about, and that is price stability. I want to dispel a few mistakes right from the start that many students often make. Very often I will hear students say things in conversation like, oh, prices just keep going up, they're going up all the time, it's ridiculous when you go to the store how high they're going. And in the long term, no doubt about it, over the course of decades, prices have increased for everything. The price of a movie that was once 25 cents is no longer 25 cents. But your paycheck is also no longer $75 a week either. So over the long term, yes, prices have had a tendency to rise. But in the short term, from month to month, even from year to year, prices rarely increase as swiftly as people think they are. It's almost become something to say. And that's one of the reasons why we always like to look at the actual data and get objective information rather than just try to make these assumptions about what is happening to the level of prices in a society. Also, a lot of times people look at an increase in the price of gasoline, which tends to fluctuate fairly great fluctuations from time to time, especially in the summer driving season, or if a hurricane should knock some refineries off of line in the Gulf. And people will see the price of gas shoot up 30, 40, 50 cents, and they'll say, oh, inflation, is here and prices are all going up. Well, rising gas prices is not inflation. Rising gasoline prices are rising gasoline prices. Now, by the end of this video, you'll see how that may lead to inflation. But rising gasoline prices in and of themselves are nothing more than that, rising gasoline prices. So we need a few definitions here. Inflation is a rise in the general level of all prices for all products across the board. And that means what you pay for your haircut, what you pay for your oranges, what you pay for your chicken, what you pay for your pasta, what you pay for your canned beans, what you pay for everything is generally increasing across the board, not just one or few things. Deflation, of course, is the opposite. And that's where the general level of prices of all things are beginning to drop. And this is another mistake I'd like to dispel. A lot of times people think that, dropping prices is a good thing. Dropping prices is not a good thing for the economy. If prices are falling, it means that producers are responding to the fact that consumers are unable or unwilling to purchase products. It means they're lowering prices to move things off the shelves. It means generally that they're nervous or scared about the future economy, that people are unwilling to buy their products, and it usually accompanies layoffs. As businesses lay off labor, because they're getting less for the products they're actually selling. When you ask people who are not familiar with terrible situations such as the Great Depression, and you say, what do you think happened during the Great Depression? What was it like? Very often they're correct in saying, well, many people were out of work, it was hard to find jobs, they were poor, but they also very often make the error of saying, and prices were really high. Actually, during the Great Depression, prices crashed. They declined. There was deflation. And whenever you have a period of long unemployment, it is often accompanied by a period of declining prices, not increasing prices. Not always, but usually. What we look for in an economy is neither rapidly increasing prices nor falling prices, but price stability, so that people can make decisions in their life, in their business. They can plan on what to expect and have some degree of certainty as to if they save a certain amount to purchase something, they're going to be able to afford it down the road. The way the government measures movements in prices is through something called the Consumer Price Index. And what the government does is essentially what I told you I did when I opened this video. They create a list, a shopping list, of what they believe the typical American household purchases in the course of a month. And they price those goods and services. And they total it up, and that becomes what we call the market basket, the value of the market basket of goods for a particular month. 1 month later, and the federal government always does this on a monthly basis, 1 month later, the government will go out and price that exact same market basket of goods, the same quantities, the same products, the same brands, at the same places, and total up the value of that market basket of goods, and look at the percent difference from 1 month to another. What the government will then do is choose a base month and call that month 100. That's where we're starting. And so if in the second month inflation is running at 1%, the consumer price index for that month will be 101. If in the next month inflation has increased 0.5%, then the consumer price index for that month will be 101.5. And the government just continues adding numbers to the price index to show how quickly or slowly prices are increasing or decreasing. Now, even though both deflation and inflation are problematic, deflation is usually a sign that we're running into a period of unemployment and businesses are scared. Inflation, a rise in all prices, tends to be the one that we concentrate on most frequently and become a little more concerned about. And there's a few reasons for this. First, inflation has often been called a tax on savings. If you're putting aside a certain amount of money every month in order to save to buy a car that, let's say, sells for $15,000, and by the time you have saved $15,000 to purchase that car is now selling for $25,000 or $30,000. Your savings has lost its value. In fact, it doesn't pay to save if by putting money away you're actually losing your purchasing power. So the first problem with inflation is that it eats away at your savings, or it works as if it was a tax on savings. And that leads to the second problem. Because of this, inflation can very easily spiral out of control. If you think that the goods and services that you wish to purchase are going to be going up in price if you wait too long to buy them, what are you going to do? Well, as a rational consumer, you're going to run out and buy that now the first chance you get. Because you expect in the future it's going to be much more costly and you're not going to be able to afford it. Well, if that's the basic opinion throughout society, that this is happening, and everyone runs out now to buy those goods and services, then what they are in essence doing is creating an increase in demand for those goods and services now. And you should know at this point that when there is an increase in demand for a good or services, that puts an upward pressure on the price of that good or service. And if throughout the economy, basically everyone is seeking to spend their money now to avoid higher prices later, what they're doing is they're pushing the prices of all goods and services up now. In other words, it's a self-fulfilling prophecy. If we're afraid prices are going to increase, we act in such a way that we actually cause them to increase. And then people say, aha, inflation is taking off. We really need to spend our money now because if we save it, it's not going to be worth anything. It's very easy for inflation to take off in a spiral that is really hard to get a hold of once that happens. In the United States, we have really never in our history seen a hyperinflationary spiral, which is defined as inflation at 200% or more. However, around the world, it is not uncommon to see inflation at those levels. The U.S. has seen, when we see inflation of 10, 11, or 12%, it's horrific. Places like Israel have seen inflation at 98%. Argentina, Chile, 200, 400%. Parts of sub-Saharan Africa, 900%. And that means prices are increasing by that much in the course of a single year. And it becomes almost impossible to save money or to wait to buy anything because your money is going to be worthless at that time. On the eve of World War II, just before the Nazis were voted into power by the German people, hyperinflation was running amok in Germany. There are pictures that Life magazine has made famous of people going to the supermarket in Germany with wheelbarrows full of Deutschmarks to buy the weekly groceries. Businesses began giving people shopping breaks in the middle of the day so they could run to the store and buy something before the price of that good doubled by the end of the day. And this is one of the economic pressures that led to the rise of an extreme Nazi regime in Germany in World War II. So, we have a situation where your savings lose value. It serves as a tax on savings. We have the danger of a spiral, of an inflationary spiral getting out of control. We also have changes in wealth, one person relative to another. In other words, maybe you and your neighbor seem to be at parity, or you were on an equal basis in terms of your buying power, in terms of your general wealth. Inflation changes that, and it changes that through three different effects that we'll discuss briefly in turn: the wealth effect, the income effect, and the price effect. The wealth effect says that people who own appreciable assets do better relative to others in time of inflation. Now, what's an appreciable asset? That's something you own that has the ability to go up in value over time. So, if you own a house and you pay a mortgage of $1,000 a month, and your neighbor rents a house and pays $1,000 a month, in times of inflation, you actually do better off. Because the house that you originally purchased at $85,000 all of a sudden is worth $200,000 or $300,000 some years down the road due to an inflationary pressure on prices. If you put your money into precious metals, into art, into jewelry, into antiques, into anything that has this ability to increase in price over time, then when inflation takes off, the value of the goods you own also take off. And you become wealthier relative to people who haven't collected those goods, who haven't been able to purchase real estate, who really have been living hand to mouth and haven't put their money into things. The second effect is the income effect. There are certain people who actually do better in times of inflation because their income increases. A few companies allow their employees or their executives to get what's called a cost of living adjustment in their salary, so that if prices increase 5% over the course of the year, their income goes up 5% at the end of the year. So they at least keep pace with inflation. And then any raise they get is on top of that, which puts them ahead. Many government workers have a COLA, or a cost of living adjustment, built into their wages. And senior citizens on Social Security have a cost of living adjustment built into their Social Security check. So that if the CPI shows that inflation increased at 2% annually, your grandparents' Social Security check goes up 2% automatically. All of those groups of people actually come out wealthier relative to the rest of the population that does not get a cost of living increase. So that if inflation is going up at 2 or 3% a year, but your wages have remained flat, you actually have less buying power than you did before. It's as if your wages have gone down. The third effect is something called the price effect. And for the price effect, keep in mind that rising prices really predominantly affect people who purchase goods at retail prices. If you're the person who needs to buy something new, who needs to buy things at the store, or who gets most of your goods and services from stores and buys retail, you are going to be hit with those rising prices. But if you are the stingy New England Yankee and you don't buy a lot of new gadgets, you fix and repair what you have, you tinker in your garage and make things last for 30 or 40 years, you swap machinery with your neighbor instead of going out to buy a toy of your own, well, that price increase is not going to affect you the way it affects those who insist on buying new. So when we put these three effects together, the wealth effect, the income effect, and the price effect, what we have on one hand is that people who own their houses outright, or who have been able to invest their cash in collectibles, who have a cost of living adjustment, such as with a Social Security check or a government job, and who tend to be frugal about buying new things, come out better relative to those who don't own property or collectibles, don't have a cost of living increase in their paycheck, and who tend to buy things new, buy new gadgets, and stay up to date on the newest new things. And if you get the impression that this would put older, more established, and wealthier people at an advantage over young people just getting started, you're right. It creates a larger gap, a gap in the relative wealth between these two groups of people. So, if inflation is about to take off, you want to be able to do one or more of those three things. Put your money in appreciable assets, scale back on buying things new, buying at retail, and trying to find yourself a job that actually includes a cost of living adjustment. Now, inflation can be caused by two different forces, and we often refer to inflation as either demand pull inflation or cost push inflation. Demand pull inflation is your fault. It's my fault. It happens when consumers run out and begin buying a lot of goods and services. It can happen when everyone's got a job, we're all doing well, our stocks have done well, and we cash in our stocks and we have extra cash that we didn't expect. During really good times, there is always the danger that people are going to spend money, too much money, too quickly, and they're going to cause inflation to take off. That's demand pull inflation. Cost push inflation happens when producers get hit with higher costs. It could be because there's not many people looking for work. Let's say it's a very low unemployment time, and so employees are able to ask for higher and better perks or higher wages. It could be because, and this brings us back to the gasoline issue, the price of gasoline is increasing the cost of transporting all goods and services, which is increasing all businesses' costs, and then they choose to pass that on to the consumer. So you have both of these forces, demand pull and cost push, that can lead to prices beginning to spiral out of control. You'll see in another one of my videos on monetary policy that one of the entire purposes of the Federal Reserve banking system is to make sure that doesn't happen and to pull money out of the economy if they fear that this is about to take place. So far, they've been fairly successful at making sure the United States does not see the kinds of inflation that other nations have seen on a hyperinflationary level, with prices doubling, tripling, quadrupling, or more each and every year. Will that continue forever? We don't know. What we do know is how to keep an eye out for inflationary or deflationary pressures by watching the consumer price index and by seeking to use those three tools, the wealth effect, the income effect, and the price effect, to make sure that if inflation does take off, we don't get left behind. That's an overview of price stability. Again, what governments are looking for are not rising prices and are not falling prices, but stable prices, so that people can plan, can have an idea of what to expect, and don't behave in a way that becomes a self-fulfilling prophecy and actually causes inflation to take off. Tom Simmons in Shelburne Falls, and about to go put my groceries away now. Thanks.